It takes us to our talk of the tape. What should investors make of either a half or quarter point rate cut tomorrow? And where does it leave a market that seems priced for a soft economic landing? Cheryl Young, Rockefeller Global Family Office private advisor, is here to talk about all of that. Cheryl, great to see you.
Great to see you, Michael.
How are you thinking about the scenarios in terms of what the Fed does, what the market expects, how we should react, and what it says about the economic environment here?
Yeah, you know, Michael, the markets are pricing in a 50 basis point cut tomorrow.
Mostly. It's almost a coin flip.
Well,
yeah.
we're seeing it fade right now,
Yeah.
and I think that's partly why I'm expecting 25 basis points. Look, I'm a data girl. I'm from Silicon Valley. The data just does not support 50. So I think we'll see 25 tomorrow. But look, I'm also a long-term investor, and I really care more about the trend than what happens in one day. So if you're a gambler, you care about what happens tomorrow. If you're an investor, you care about what happens over the next year.
Yeah. You call them speculators, maybe, not gamblers. There are plenty of them out there watching. But you say you're focused on the data. What particular data says 50 would be out of bounds? I ask because it seems like a lot of the reports and the chatter and the commentary in the last few days has been directed at building a case for why the decline in inflation to current levels and just how high rates are compared to that really do allow for more room to ease up front with a 50 basis point cut rather than waiting and going small.
Yeah, you know, you could make the argument that they should have cut in July. And I think that's part of the pressure on the Feds tomorrow is they really should have cut in July. But look, stock market touched all-time high today. Unemployment is still at really reasonable levels compared to long-term, although the velocity of the last year is why people are considering the 50 basis point cut tomorrow. So you have to weigh all the data. GDP is still very strong. We still don't see recession ahead of us, but things are softening. And I expect GDP to still be, 1.5 to 1.7 next year. So we're not seeing that decline go negative. And unless we see recession territory, we just don't want to get really too far away from controlling inflation either, which is the balance act. We still have to keep that inflation check.
I mean, that would net out to a pretty positive view on the economic backdrop, right? I mean, if you really think that there's time and if we cut by 50 basis points, you're still above 4.75%. So it's not as if you're all of a sudden stimulative. I guess the question is, are the stakes particularly high with the decision tomorrow, or do you feel like we're in a decent place either way, or we're vulnerable either way?
I don't think we're vulnerable. I think we're in a decent place either way. I think either choice is going to be a good choice. Now, there's probably no chance of a no cut. That would be the disastrous scenario where the markets would really react big. 50 basis points does, potentially put some question mark at what data are they seeing that we're not seeing. Are there more signs of bad news ahead? And I think that's the reason we will get a 25 basis point cut. But look, either one in the long run is not going to move the needle that much. And we expect 5 rate cuts over the next 12 months. So whether they do, 2 and 1 tomorrow or stretch it out, either way, I think we're going to get to the same effect over the next year.
And, of course, there's going to be plenty of guidance and the Fed's formal outlook to chew on after the fact to get a sense of what they envision in terms of their pace. Retail sales this morning were okay. I guess you would just say no incremental reason to be further worried about the consumer, even if it wasn't a gangbusters number. In terms of the market, you've had this phase where kind of more defensive groups, rate-sensitive areas of the market have outperformed, and now you're finally getting some of the consumer cyclicals catching up. But the rule has been the winners of the first half of the year have not done a whole lot since mid-July, right? The mega-cap growth stocks, the semis. I think you were concerned to some degree about the concentration of the market in the first half. Where does that leave you now?
Yeah, when I was last on with Scott in June, I was really concerned about the price, especially of semiconductors. That sector has had a 25% sell-off twice, August 5th to August 7th, and again around September 6th, and has bounced back off those lows considerably. However, semis tend to lead, and you really have to pay attention to how they're moving. So that double bounce off the bottom has me a little bit concerned. Valuations were really high. If you look at valuations on the tech sector, it's almost double that of the rest of the S&P 500. And so we really want to see this broadening that we've seen kind of come into play since July continue for a healthy market. When you have 63% of the returns come from 7 stocks, and with 61% last year, so this is not news. This has been going on for a long time. There's just a lot of concern about how healthy the economy is. Over half of the market, if I look at the S&P 500, is still 48%, so I'm rounding, still negative year to date as of right now. And so that's just not the healthy market we want to see. We want to see that broadening continue. We want to see some of these beat up sectors continue. But my concern also is, if I look at utilities, just for example, that's a more defensive play, and we've had a huge rally there. There's some names that are at P ratios that look like tech P ratios that really doesn't fit with what a utility should be trading at.
Yeah, it's been a noisy stretch here the last couple of months. So let's bring in SoFi's Liz Young-Thomas and CIC Wealth's Malcolm Ethridge. Malcolm is CNBC contributor, broadening out this conversation. Liz, talk about tomorrow's decision, and I guess just to the degree to which we feel like it's going to be a major swing factor in terms of how the economy breaks and how the market adjusts to it.
Well, I think it is going to be a swing factor in the market because there's not certainty about what they're going to do. This is the first meeting in a really, really long time that I think we're going to go into it really not knowing what's about to happen. So that in and of itself is likely to be
Someone's going to be disappointed either way.
Someone's going to be disappointed. Somebody's going to be wrong. And that's a new experience that we're having as investors. So at that period of time, and I say this all the time, that period between 2 o'clock and 2:30 p.m. is the most dangerous time to trade because they've made the rate announcement, but they haven't had the presser yet. So heed the warning that is a dangerous time to be playing with the market. But the decision of between 25 and 50, I think that they should do 50. It would be out of character for them to start with 50. It would look big. It would be aggressive, so to speak, based on their history. But if they know that they need to do that at some point, if they know that they need to get to a certain point before the end of the year, why wait? And particularly, why wait until the day after the election results? Hopefully results actually come out. Why wait until then and be accused of being more political? So I think they should do 50. I think that the labor data has disappointed them. It's gotten cooler more quickly than they expected, given that the unemployment rate has already overshot their year-end target. So I think 50 actually would not be that aggressive, especially considering that on the way up, they did 25, 50, and then 3 75s in a row. That was really aggressive. So why not get it started with 50 and manage the messaging? Yeah,
it seems as if, I mean, it's worth remembering that they've been on hold since July of last year. That's 14 months. It's an unusually long period to kind of keep rates at cycle highs. And so over that time, I guess it probably, and the reason that the 50 basis point chatter has probably kicked up, whatever. Maybe there's leaks. Maybe there's people deciding to try and kind of push the debate in one direction or another. Is that 5.25 to 5.5 on the Fed funds rate increasingly looks out of whack with all the things you mentioned, right? With the upturn in unemployment, with where inflation has gotten to. And I guess the question is, with the S&P already up 18% this year, you are starting to see, like 60+% of all stocks are now in an uptrend. In other words, it's not as if the market expects bad things from the economy. So we're not priced for a further downturn, it would seem.
Right, which would send the message that the market can absorb it. Now, maybe it would have some jitters initially if the 50 was a surprise to people that were expecting 25. But the market right now seems to me to be priced for a soft landing. We're almost pricing that in. We've got this broadening out going on. You've got small caps outperforming the S&P over the trailing 3 months. The sectors that are leading are either rates-driven sectors, some defensive sectors, but I'd also call those dividend-paying sectors that are trying to anticipate further drops in yields. So the market is telling us that it has resiliency under the surface and the average stock is doing okay. The economy still doing okay right now. I'm of the mind that we're actually just making a stop in balanced territory on our way to weak territory. But right now we're balanced and that's okay. And the market continues to be resilient and there's buying power out there. So that's another reason. I think the Fed can afford to do 50 tomorrow, and we just have to manage the messaging around it. And that messaging being, just because we did 50 today doesn't mean we have to do 50 every single time from here on out. But the risk of only doing 25 and then having this big gap of time between the September meeting and November 7th and having all this data roll in cooler and them looking too far behind, I think that risk is much higher than just doing 50 and trying to manage the message.
Malcolm, where do you come in on this in terms of which is the choice that is likely to lead to the least regret down the road?
Yeah, I think Liz's point about needing to just get it over with and go 50 now is a good one, but I think that the Fed is more likely to go 25 here just to keep from spooking the markets. It's a safer bet. It's the more consensus bet, right? If we just listen to the remarks coming out from a lot of the Fed officials who have kind of tried to front run this thing, they're really not all on the same page. And so the easiest way to get to a consensus is to go 25 rather than the more extreme case at 50, because it's really tough, I think, to message to the markets that, yes, we went 50, but that doesn't necessarily mean that we see a whole lot of bad out there today. We're just trying to be data dependent once again. I think that the more impactful way to go about it is to do 25 here, see what happens, and then maybe go 25-50 the next one.
You don't think that the past 4 or 5 days of people kind of laying out the case for why 50 wouldn't be a panic move and it wouldn't really be because of some kind of an urgent emergency that the Fed is responding to? You don't think that the markets could live with that as a message?
I don't, because to your point, we've been in this holding pattern for 14 months now where we haven't seen cuts at all, which is unusually long. And so a big shock to the system would be an interest rate cut, anything bigger than the smallest possible required cut just to start the easing cycle. So you can always add to it. It's really tough to take it back once the toothpaste is out of the tube, though.
Cheryl, in portfolio terms, what does it all mean right now? I mean, what would you be telling clients about, where we are in the cycle, whether you feel like this bull market is in a fragile position? Are we okay? How should we set expectations for the rest of the year?
Yeah,
I think that's really.
Sorry, Malcolm. Cheryl's going to jump in on that for a sec.
Sorry, Malcolm. We'll give it back to you in a second. I really think you have to ask yourself at any of these juxtapositions whether something has materially changed. And look, the markets are, the Fed fund rates is at a 23-year high.
Yeah.
Jobless numbers are at a 3-year high. So you have to look at this and say, yes, something has materially changed. So what has worked for the last year, 2 years, may not be what is going to be working going forward. And I would love to say I still love my technology stocks, because if I sold them all, I'm going to get crushed in taxes. My clients would kill me, right? We have to think about the overall tax effect. But I do have to think that there has to be some rotation. Technology has been on such a tear. The valuations are too high. And the story has changed. What has done well during a flat rate environment or a rising rate environment, which is what we've had for the last decade and then the last 2 years, is not necessarily what's going to perform well during a declining rate environment.
Malcolm, I know you're an owner of some of those big tech stocks. You can kind of weigh in as what we were saying before about the portfolio approach, but also, Microsoft, for example, out there, been one of the leaders for years.
Yeah, I think it makes logical sense to say that rotation now is finally the setup. We've been asking, when is this rotation, this broadening going to happen for more than a year now? And I think you could make a logical case that maybe it's time to rotate into things like financials and energy and so forth. But I also think in an accommodative rate cycle, it allows for some of the other tech names that haven't really participated to the level of the hyperscalers to actually now borrow to invest in artificial intelligence, because they don't have the fortress balance sheets to do it on their own, like, say, an Apple, right? You have HP, you have IBM, other names that need to invest in refreshing their hardware today and integrating AI into it so that they can get ahead of where their customers are going to be looking to them for those baked-in AI solutions later. And so I just don't think that it's necessarily a foregone conclusion that today is the day or tomorrow is the day that we say we turn away from tech altogether. And maybe it makes more sense that we're broadening our holdings inside of the tech sector more likely.
Yeah, well, I guess if we're going to get a full rerun of the whole internet run up, we need leveraged CapEx investment in tech, because that was a big part of it back then in that final phase. Liz, you suggested that we're in this kind of maybe delicate equilibrium here in terms of the economy, kind of slowing to a point where you think it's going to lead to a downturn. Is there a way to avert that? Is the bond market telling us that's a done deal?
The bond market and the stock market have been sending conflicting signals for most of this cycle, and usually people rely on the bond market more, and now it's looked like maybe the bond market has gotten it wrong. Is there a way to avert that? I don't know that there's a way to avert that. When we look over history at the times when in a cutting cycle we've pulled off a soft landing, so in the 80s and then again in the 90s, both of those periods, that was happening into a strengthening labor market. So unemployment during one of those times was, I believe, over 7%. Another time it was at about 5.6%. Both times the unemployment rate was falling. That's not the case today. So when you think about just where we are in the economic cycle and the fact that unemployment seems to be on the upswing, and we're just at that balanced place where we've got about one job open to every unemployed worker, That's what makes me concerned. Usually when you draw the correlation between cutting cycles and the unemployment rate rises pretty clearly and actually pretty dramatically during most cutting cycles, except for those 2 periods when the labor market was strengthening.
Yeah,
so I just don't think the conditions are present for that to happen.
I'm going to circulate a petition to have 2019 categorized as a contingent soft landing because they did cut, and I don't think that the yield curve predicted COVID. So, but anyway, it didn't play out long enough to know exactly how it was going to go. Liz, Cheryl, Malcolm, thanks so much. Appreciate the time.